So yesterday, my little redheaded daughter comes in and she's crying. I said, what's wrong? She says, there's a snake and it's killed 2 of our chicks. And so I had to go out, and thank God I had a BB gun, and I popped him in the head with the BB gun. Now, some of y'all are going to say, Bobby, you don't kill rat snakes. They're good, blah, 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 blah. Listen, he had one of my chickens in his belly. You can see a big old thing, and he had killed another one, and I killed the son of a gun. Of course, I screamed like a high school cheerleader as soon as I popped him, because I was like, oh, he's going to be mad. And he did rear up against me, but ultimately the shovel took his head off, and 2 of my baby chicks are dead. So I'm left with 4 baby chicks. Now I got 3 old chicks plus 1 old chicken and 3 goats and 3 pigs. I got a lot of 3s for some reason. And we actually trade 3 accounts here on our channel. Oh, by the way, if you're thinking of only watching 2 or 3 minutes of today's broadcast, you need to stay around. We got an important thing that we're going to cover today, and that's why I apologize for being late. All right, so let's look at the market. The market is dead. VIX is dead. We should be getting paid, right? So let's see what our big green monster looks like. First of all, so our big green monster, where's that darn thing? Hold on, here we go. Big green monster looks like that. So we are at a area of support / resistance on our 20% line. It would not surprise us to see the chart to fill in this area here. This is our point of control, which is always a magnet. However, you need to realize that even though we're going there, we are going. Let me show you where we're going. You got any questions about it? We're going to the 43.33. It is just a matter of time. But we may test these areas first. So we'll see. This is kind of where I expect the market to go. We're going to 43.33. We just don't know when. And definitely it's going to go to 42.43 as well. So we got about a 100-point little gap there that we'll probably fill in. So we'll be on the lookout for that. Our point of control should fill in up here at some point, and that would be much more bullish. But for now, our point of control is right there. All right. So let's look and see how our accounts are doing today. Let's look at our linear regression first. We decided that we should hit the 43.33 on or before, what was it, June the 16th. Today's the 6th, so we got about 10 more days, we think, before we'll hit the top of our little chart over here. All right, our account is, look at this, 86% probability of profit. We are at 38,198. 38,198. And I finally got this stupid thing to work. 38,198. Ha ha ha. Fire up the band, Rico.
Well, we're moving on now. To the side. To a deluxe apartment in the sky.
Yes, hallelujah. So look at this. Our deltas are 43.49. 43.49. Normally, I don't trade behind y'all, but yesterday I did a couple things. I closed a couple of those call spreads after we got finished yesterday, and just made me more comfortable. I hate calls. So I closed a couple of them, but I try to do all my trades with y'all. But if y'all got any questions, let me know. So our buying power today is at 8,665. 8,665. So we are, what do you call, sunning and styling and profiling. Look at this, y'all. We're a little hot on our Theta, but who cares? Look at this. This is nice. This is nice. We're at 22% buying power. It is not the time to be a hero. I cannot stress this enough. Volatility at 14. Do not be a hero. Do not put too many trades on. Keep your Theta low. Keep your risk low during this current time. Okay, so let's close that one. And let's go to the IRA before we get into a very, very valuable lesson today. So the IRA is this one. So we'll go over here and see how much money we got in here. We've got 86,523. 86,523. Oh, look at this, y'all. 86,523. Rico, fire up the band. Yes, glory. All right, so over here we are at 80. Wait a minute, what in the world? Normally they don't show deltas on there. Oh, we're not beta weighted. That's why. There we go. Beta weight SPY. Dang it. I said we want a beta weight SPY for the. There we go. There we go. Make sure you're beta weighting your SPY. So we're at 2.78 gives us 80 loans, 80 and 80, 80 and 79, 80 and 79. Let's see how that looks. 80 and 79. Beautiful. Okay, we're a little low on the Theta. So we're going to take care of that by putting on a trade today. But before we do, we've got an important lesson that we need to talk about. I keep talking about the lesson today. So our buying power is at 21,000, about 21.1. Okay, so we need a little bit of Theta in this account. No big deal. We'll do something to get us a little bit of Theta, and we are pushing the max buying power 25%. Okay, so let's go to the final account. See how we're doing in the Crimson account. Our bellwether account. This is the one I'm always able to keep stuff in. So over here we are at 35,954. 35,954. 35,954. Come on, but oh yeah, look at this. 35,954. Fire up the band, Rico.
We're moving on up to the side, to a deluxe apartment in the sky.
What metric did I use to help me decide if it's the call spread? That's a good question, Eliza. I just hate them. So I think I paired a little bit of them off. Yeah, really wasn't a metric. It's just like, God, I hate these things. Hate them. Okay, now, ladies and gentlemen, I want to make sure that I tell you every time that I'm making a deposit into my account. Now, I don't want to brag, but I got a huge settlement yesterday from Zoom. You know, the Zoom that we use every day. So apparently Zoom did me wrong in so many ways, and they owed me a settlement. Now, I don't want to brag, but I took my settlement and I said, it's unexpected windfall. It's an unexpected gain. So what would you do with an unexpected amount of money that came into your coffers? You put it into your trading account. So I do need to let you know that I deposited my settlement of $32.32 yesterday into my trading account. Any questions on that? Yeah, I know. Thank God, you know. I mean, I was sitting here, you know, we were running on fumes in the Gaines household, and all of a sudden it's like, you know, you're playing Monopoly in the community chess, you know, hey, you won a settlement, and I got a whopping $32.32. And I thought, you know, I could take the family on a vacation. We could go to the beach, or I could put it in my trading account. So I put my $32.32 in my trading account. So I wanted to be totally forthright with you guys and let you know that. Okay. Yeah, fortunately, Dwayne, my attorney is not taking 33% of that. The class action lawsuit or whatever. And by the way, if you use Facebook, every one of us, I told Beth yesterday, every one of us that uses Facebook, there's a Facebook settlement where we're supposed to get like $10 or something. And you need to just search for Facebook settlement, and they owe us money. And Beth was laughing about it. I said, girl, you go and you apply and get your $10. You done it yet, Beth? You go to Facebook settlement and do it, woman. I did it so I can get my Facebook settlement. Okay, so we got $32.32. Beth, I didn't tell you about the $32.32. I didn't want you to get overly excited. Oh, I did tell you about it? Yeah, I tell everything. Yeah, from Zoom. Okay, baby, I'm just making sure. All right, so let's see how we're doing over here in this thing. So we are at -8 and 25. 26 minus 8 is what? 18. So we're at 1835. So let's look at that, 1835. Okay, so I am at 0.10%, so I don't really have to do anything on this account. And our buying pair is 9,100. I can't do that in my head. I don't. 9,100 minus 1718 is 7382. So let's put that in 7382. Beautiful. I don't think I got to do anything on this account. I think, you know, I'm at 0.10%. It's round in blue, but that's where we need to be. So I think we're good here. This account is good. Okay. Now, if you're not in our Discord group, you're missing out on tons of education. There's a link down in the video below, and you need to join our Discord group because Victor, are you here today? Yeah, Victor's here.
Yep.
Victor did a really, really, really nice little thing in his Victor Steady Income room. And I want to read this to you. Okay, this is very good. And he calls this the case against the residual PDS. He said, I know it's tempting to put debit spreads are already paid for and are providing additional protection to the portfolio, but that doesn't tell the whole story. Keep in mind that I am talking specifically about the 11X and my 121 trades here and not other structures which might behave differently. We know there are no free lunches, and those PDSs were paid for by taking on additional risk. You can argue that you paid for them directly, but to get the money to pay for them, you had to sell something and take on additional risk over and above what would be required to maintain desired Theta profit. If you keep them open after the corresponding naked puts are closed, it means that you probably overpaid for their initial purpose of protecting those naked puts. If you are layering them up to get to a certain level of portfolio protection, that means that I would argue that the better way is to ensure that any trade can stand on its own at any point. I understand that we are trying to be portfolio managers, not trade managers, but this is not contradicting that goal. By making any individual trade stronger, we're making the whole portfolio stronger. You are still considering the whole portfolio to decide if you should put on a new trade or if you should take some risk off. I'm just making a case for making PDS shorter in durations than your naked puts and not counting on them as a portfolio protector after the naked puts are closed. Some cost same width PDS will always be closer to the money if the DTE is shorter. This is important now. Listen to this. Victor has just told us that a put debit spread that is closer in time to expiration will be closer to the spot price of the underlying that we're trading. It will react faster to a market pullback because both the delta and the gamma of the put debit spread will be higher. By ensuring that the difference between the naked puts and PDS is no more than 21 days, you are given the naked puts enough time to decay to the desired profit level in usual market conditions. If the market pulls back before that and you need to manage the naked puts, your PDS will show more profit at that moment and will offset the loss more than the equal width longer DTE put debit spread would. Now, this is kind of an important thing. And I thought it was very well put, and you guys can go to Victor's room and read the rest of it. But here's his portfolio graph, which looks really good. Now, he does say that he's got some call debit spreads up here that's kind of contributing a little bump up to the upside.
Credit spreads.
Credit spreads? Oh, you got some call credit spreads?
Correct.
Okay, he's got call credit spreads, but doesn't look like that's working against you. And he's got that amazing hump that is down past a 2 standard deviation movement to the downside. Now, ladies and gentlemen, what he said, I took to heart, and it makes so much sense. By lowering the DTE on the put debit spread, it does get it closer to the money, which means the hedge can come into effect quicker. So this was similar to what we were doing with the triple nipple donkey, right? For those of you that remember the triple nipple donkey, the only problem with the triple nipple donkey, oh crap, I'm on the wrong thing. Hold on. The only problem with the triple nipple donkey is we were getting messed up by what? We were getting messed up by the Sweet Bobby hedge. But the fact that we were doing, let's see which one is going to be it. This one. Here we go. The fact that we were doing them shorter, the put debit spread was still sound advice, I think. So let's say, for example, you're doing your 60-day DTE naked put. Okay. Now, my plan says that what? I'm going to take that off at 90% profit, or I'm looking to manage that at about 28 days. But for my formula, I basically said that management will come at half of the DTE. So 1/2 of 60 is 30. Okay. So in Victor's world, you could say, okay, well, let's just make the put debit spread for the 30 days protection of that particular thing, instead of going, oh man, we're going to layer these things up. It's going to give us awesome kind of protection, blah, 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 blah. But that made a lot of sense to me. That kind of resonated to me. Now, what Victor's doing is he's doing them, I think he's doing his naked puts at about 60, and then he's moving in about 14 days. So about 46, 45 days to put on his put debit spread. But if you're, depending on what your management is, if your thing is, hey, I'm going to take my put off regardless, my nakeds at half the DTE. So if I put them on at 60, I'm going to take them off at 30. That makes a lot of sense to then go, you can get closer to the money and get better protection by doing you a 30 DTE put debit spread. Makes a lot of sense. Does everybody understand why it's closer to the money? The less, it's the same thing as selling something, right? If you sell a 0 DTE 10 delta put, that 10 delta may be a 30 delta at 30 DTE. Victor, did I do a good job of explaining what you said? Yeah, I thought this was a really, really profound comment that you made about the put debit spread. I thought it was really good. Do you have anything else to add, Victor?
Well, thanks for bringing it up. It's nice to see that you did a good job. You know, my mechanics are a little bit different because I look for certain payments and a certain delta. So I end up usually between 60 and 80 days, depending on the, you know, on the VIX and whatnot. And then I look for the available put debit spread around 14 to 21 days under, but you know, there's not many choices sometimes on the available DTEs. So sometimes you have to go with 10 days, sometimes 14, and sometimes 21, but no more than 21. And I personally am fine with 80%. And 80% profit. That ensures that after paying for put debit spread, I'm left with a 50%, minimum 50% of the original collected premium for the naked puts. And I always sell 2 naked puts at 9 delta, wherever I can get at least $20 for each, and that ends up being on somewhere between 60 and 80 days. And then at 80%, I can close them, knowing that I booked in the 50%, and I can let them going further to 90 or 95, but at 95, I would close them regardless, because I don't want to hang around for the last 5%. So right now I have some at 90 and some at 80, and I could close any of them, but I don't want to close it because it's not the best time to open a new trade. So I'd rather have them decay a little bit further, and then maybe open a new one when the market pulls back a little bit. But overall, yeah, you broke it down good. And as you know, I do a little bit different naked puts. I mean, the put debit spreads, I do them wider and further away from the money, but they give me more protection in a pullback, in a larger pullback. But yeah, good job.
Yeah.
Thanks.
Beautiful. So let's go to the account that needs a little juice in it, right? And we don't have to put a lot of juice in it, but let's do something to where we would go, okay, let's trade this in this account, right? This is the one we needed it. And let's go to MES. And let's say we're going to do the 112 like we often do. And we go and say, you know, my plan. Now, guess Victor's is different. He goes to whichever DTE that his 9 delta will get $20 in credit. That's fine. Hey, man. See, Victor has made the plan his own, which is really, really good. And everyone should. Don't blindly follow my logistics and strategy. Develop your own. Now, each of you have a copy of my trading plan, but make it your own. Change it. Get what you're comfortable with. But my trading plan says go closest to 60 DTE, so that's 55. And I like going to about that 9% that he talked about probability of being in the money. So we go look at that. 9% probability of being in the money. See, he would not go to this expiration because this 9 delta is only giving you $14 or $15 worth of credit instead of 20. So he would go farther out, and that's fine. It's no big
Right,
deal.
and the reason for that is because I want to spend 25% on my put debit spread consistently
Yeah.
from the premium I collect, which gives me, if it's 20, then it's 40, so it gives me $10 to buy a put debit spread. So that keeps it consistent. So I always know at 80% I've collected my 50% profit overall.
Gotcha. And that's beautiful. I love that plan, right? Mine doesn't necessarily say that. So I could be totally happy of me going here and selling me 2 at 15 or 15 and a quarter. Let's see if we get filled here. And then we're going to show you something. It's kind of cool. They're going to make me do 15. That's fine. So cancel replace order. 15. Now we're in with our naked puts. Now, here's what. So we're at 55 days, right? So we're saying if we're going to close that at half of the time, 55 divided by 2 is we need put debit spread protection for this naked put of 28 days. If I'm going to close it at the end of 28 days, right? So what we could do is let's go build one. If you were going to do that trade, let's go to the micros. There we go. Table. And what do we got? 24 or 31? Well, we want 31 days of protection for that particular one. Long put vertical. Now, here's the way Victor does them, and let's just kind of do it together here. So he does a 300 wide. So 4,300, and I go this one all the way down to 4,000. Now, depending if you want grind down protection or you want crash protection. So let's bring this down to 4,000. Okay. And then same thing. He's paying the same amount of money that we normally do on our regular, right? So there it is. It's the 4,100, 3,800 for about $10. So let's go look at that. 4,100, 3,800. So we'll go here. We decided we go to the 3,100. So 4,100, 3,800. So we'd be selling the 3,800. And we'd be buying the 4,100. For about $10. Let's see if we can get filled on that. And then we'll look at it together. Probably gonna make me go to 10 and a quarter. And we're in. Okay. Now let's show our groups, and I think I can show you what this thing looks like. It's really cool. So that's kind of his 1-2-1 trade that I call it. So let's go to show groups and go to the analyze tab. And MES, go all. We want to hide simulations. May look like that. Let's see. Single symbol, all groups. Nope. We want to do the unallocated. There she is. There she is. Unallocated. Let me make sure that's all it's got in it. It should have those 3 trades, right? It's got the one. Here's the 1-2-1 trade. So really kind of cool. Isn't that cool? Victor, did I do justice to your trade? I hope I did.
Well, generally, yes. I wouldn't do it like that because it's just not enough money for me. Because it's a little bit too much to pay 10 euros for me if you only collected 30, and then if you take it off in 30 days or something, I think it might be it wouldn't be enough for me. But I mean, if it works for you, obviously, then it's great.
Sure, and I'm more at a portfolio level rather than looking at the individual trade. I just know that I needed Theta in the account. So what I was able to do today by this particular trade was add $3.14 of Theta to the account. So Carlos, Victor, so you close your put debit spread. You do not try to reuse for another tranche of decades. I think that's right, right? Well, you don't close it, you just let it expire, or how, or do you close it, Victor,
Yeah.
after?
Well, they're generally very close to being expired by the time I take the naked puts off. So if there's few days left, I can just leave them on. But if for some reason I want to close my trade early and there's some money in those credit put debit spreads, I'll close them and collect the money to beef up the profit in that trade. I just want to make sure that I get 50% overall. So let's say I'm closing the nakeds at 70 for some reason, at 70% instead of 80. Then I can close the put debit spread and collect the other 10, 15, whatever whatever it is to get to my 50%. I don't count on that to stay open. I don't mind if it stays open for a few days, obviously, but I don't count on that.
Let's look at it over here, y'all. You can get a better sense of what the trade is here. Let's see. Get that down and then let's back out. Yeah, here we go. So this is why I call this a 1-2-1 trade. It's kind of cool because, you are getting protection. Look, your max profit is, if it were to go down to your naked puts. Look at that. That's where your max profit goes. It's kind of like a butterfly. It really is. It's a strange little trade. Now, if you go down here today, your toast, right? You'd have, what is that, $305 loss today if you went down there. But look, at expiration, that's your max profit. So your naked ends up being in the middle of your put debit spread. Very cool. Very cool trade. I love that.
Keep in mind, it's very unlikely that you will collect any of that max.
Very unlikely. Very
unlikely. But it's designed to give you a lot of protection as it goes down. So I try to optimize for something. So I optimize for the pullback of maybe somewhere between 7 and 10%, which is a stronger pullback that it wouldn't put me out. It would give me some time to maybe start closing some trades and things like that without losing too much on that pullback. So the high structure in the back will lift everything in front of it as it moves down. So anyhow, just thought.
But Victor, I see exactly what you mean, though, by you're getting better protection quicker by putting that put debit spread closer to expiration.
Exactly.
Yeah. Boy, I mean, that's what I mean, y'all. If y'all are not a part of our Discord and you're not looking at some of these rooms and what people are talking about and people are doing, I mean, I can imagine a lot of people probably just missed Victor's wonderful analysis of, hey, man, use your put debit spread for what it's. But look, are y'all as scared about a naked put at 39.10, knowing that you've got to put down here at 30, or knowing that you've got long at 4,100? And that this, I mean, this is kind of wrapping around your nakeds and giving it some bit of protection. It's really, really cool. And I see what you're saying. Let me make sure. Victor's looking at it on a trade level, and I'm looking at it more on a thing. But let's look at the individual trade. So this cost me potential spam. So if I got $15, create duplicate order on that. So that gave me $147 credit. So let's put that in. So we got $147 credit. And I spent $50 on the put debit spread, right? So that's a $97 credit. So if I got 147 and I'm getting 90% of that or 80% of that, I'm gonna make $132 on that particular one minus the 50. But what Victor's saying is, hey, you may not get the 90%, you know? He might close his at, you got 147 credit. He might close his at 80%, get you 117 minus the 50 that you spent for your protection. So that overall trade still gives you $67. So he's doing $20, right? So he's getting a credit. Let's say that's $200, right, Victor?
Yeah, that would be the minimum. Generally, I get around 20, 22, 21, 21 and a half. Well, say 21. So 210 roughly.
So so he's getting 200, 210. So he's getting 80% of that. So he's taking the larger, so he's getting 160 minus the 50 that he pays for the protection. So he's making about 110, 120 bucks on every one of those trades. And Stacy, yeah, the statement is this, and let me go back over this, Stacy. This is good. If you want grind down protection, I would recommend that you do the 50-point wide put debit spread. Okay, everybody with me? The plain Jane, hey, the market's going to grind down. That's where I really want my protection to be. Do a 50-point wide. If you want more of a crash type protection, you know, standard deviation or more move to the downside, you're probably going to do better doing the 300 wide on your put debit spread. I don't know, Victor. I kind of like what you're doing is saying I like going out to where I can find the $20 credit so I can make $100 or more on these trades after commissions. It's kind of cool too. I could see me doing that easily. You know, let's go to whatever expiration it is that allows us to get the credit that we want for that particular trade. It's just a beautiful trade, y'all. What does it look like with a vol jump? Well, let's see. Let's see, it's probably better to do it. Evan may have to help me over here to do this. Let's say I go over here, vol jump. Let's see, I go increase the volatility. How do I do this? 6 today. Which ones do I do this on? Here it is. July 7th, July 7th, July 31. So you could increase the volatility 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay. So 5% up in volatility. You saw what it did, right? It makes this go down. Let's do it again. Let's go with another 5. 1, 2, 3, 4, 5. That's working against us. But this one's working against us. 4, 5. So now we've gone up 10, 2, 3, 4, 5. So then if you had a movement down to your 39.10, your profit or loss is lost $940 on that particular trade at this particular point in time, rather than a $300 loss. Is that pretty good, Carlos? Hey, someone's got their hand up. Evan, my man, Evan.
Yeah, it seems like you've kind of decided that this is something you want to do just as a, I guess, heads up to other people, or kind of playing the devil's advocate here. This is very similar to the T&D campaign where we were advocating for crash protection versus grind down protection. And when we got grind down versus crash, everybody went, oh crap, I am down 1%, the market's down 1%.
Yep.
So when you start doing wider put debit spreads, and I talked about this with Victor a while ago, I'm pretty sure we were live, you're not going to get the same level of grind down protection.
Exactly.
And so that 300 wide put debit spread really only kicks in if we drop something like 10 or 15%. Anything before that, you're going to feel the pain of the market as it pulls back. So something to keep in mind.
Yeah, that's good, Evan. And what I plan on doing is just I'm gonna sprinkle it all in. I just want to sprinkle some of this, some of the 50s. I'm probably still going to be predominantly doing my 50 wide. No doubt. I love that grind down protection. That's mostly what we need. Most markets we found in 2022, it was, even though the market was down 20%, it was grind down. Most time you don't have crashes. you don't have the crash, and that's not the protection that you need. And we think that we have found ways to alleviate or at least get out of trades that are potentially going against this big. So my thing is probably to steal the 50 wide is what I will do predominantly. And I will sprinkle in a one of these 300 wides. Yeah, but I'm definitely don't think that this changes the major strategy, but it's kind of a cool thing to have a little bit of diversity in our DTEs of our trades. And that's what I finally agreed, Evan, that I was going to do with the credit spreads too. I don't want to abandon our 111s and our 112s that have worked so well. So I may sprinkle in a credit spread ever so often, but the predominant trade that we do will always be the 111 and 112. Since I was visited by the ghost of the 112 trade, who said, Bobby, why hast thou forsaken me? And I'm like, I'm so sorry. That's just a different variation. Eliza says she's been experimenting with the calendar structure with a wide put debit spread and a 2-2-5. You know, there's all kinds of things that you can do with this. Look, here's the important thing. Here's what I want everybody to gather from today's session. Your primary goal is to manage your Greeks and buying power. That is your number one goal. Do I have enough gas in the tank? So now, this should be, let's see, let's go over here and see what we got going on. We should have about $82 worth of Theta. Now we got up to 80. So we got 80, and our buying power is 22,000. Let's go 80. Okay, I only went up $1, but markets are moving, things are happening, right? So I increased my Theta by putting on that trade. And let's see, this went to about 22,000. I'm about at probably 25 now. All right. Right now, we need to keep our Theta at about 0.1. You may even be a little hot at 0.1. 0.09 may be where you want to be. That's your goal. And keep it here as often as you can. When volatility increases, feel free to go a little higher on your Theta. On some of our accounts, we are a little high, aren't we? Let's see. No, we're 0.1 on this one. But this is where the primary thing is. And I don't care if you're selling strangles, iron condors, credit spreads, 111s, 112s. It is a Theta game that we play. And keeping Theta in the tank is our goal. So if you keep Theta in the tank of 0.1 on a $35,000 account, that is 0.1%. What am I saying? It's on a $35,000 account is, well, let's look at it. That's $35 a day times 365. That's $12,775 if you kept all of the Theta. Now, you're probably not keeping all the Theta. 12,775 divided by 35,000. You're not going to keep all your Theta, right? That's a 36% return. If you keep 25% of that, that's going to be a 9 or a 10% annual return. That's why a lot of times I don't mind my Theta being a little high, but that's generally when VIX is higher. When volatility is low, you're going to expect our annual returns to be a little less than what they're going to be than during high volatility environments. Just part of it. But y'all, if you can peak out a 12% annual return, you're better than Bernie Madoff, and you're actually doing it. Oh, Bernie, 1% a month, Bernie. Doesn't matter what happens. He's going to do 1% a month. That's Bernie. I think we can do better. All right. So we've done 3.41. No, we've done, 3.41, 2.37, 2.62, 1%. Okay, we had a bad volatility month. Okay, those come in, right? But still, y'all, we should be able to do, the 12 to 20% a year. I think we can do it. Keep your Theta in the engine. It's very exciting, actually. Can you imagine if you could do 12% a year, you're among the top hedge fund managers in the world, because all of you are hedge fund managers. You're managing your own hedge fund. you can do that, you're among the top in the world. Every now and then, this is going to hit you. Yeah, we had a little trouble. But most of the time, 2-3%, 1 to 2 to 3% a month, yeah, you're going to kill it. You are going to kill it. Victor,
I'm trying to find this little hand that Ivan had on. I can't find it on the Zoom. How you?
Evan knows where the hand is. I don't know where the hand is either. But anyway, go ahead, Victor. Yeah.
Anyhow, I just want to mention, like, speaking of Greeks and buying power, just one, and again, the width of the put debit spread, it's really individual, and you can do it either way, and everything works. Both of them can work. But one hidden benefit, well, not so hidden, but maybe we don't pay attention, is of the wide put debit spread is a significant buying power relief that you get versus the narrower one. It's probably like somewhere around 3 times more buying power relief. So your individual trade costs you less, and so you can keep your overall buying power lower than you would otherwise be able to. I mean, you get things the same for the naked puts, but then when you add on the put debit spread, I think you get a relief somewhere in between 200 and 300. I think you just had on this one earlier, like even 400, depending obviously on other trades that you have in the account. But apples for apples, you get more buying power relief with the wider one. So that's something that if you monitoring your buying power or something, that's an additional benefit.
Beautiful. Beautiful. Okay. Anyone got any questions about this at all?
Yeah, I do. This is James.
Hey, James.
Hey, I don't know where the hand is either. I need Evan's. I need his expertise on where the hand's at. But anyway, Victor, Victor, could you tell Bobby exactly if you were trading this today, and I'm assuming you're trading on ES and not SPX, but if you were trading on ES and you were trading it today, could you walk him through setting that up?
I do it in MES, but ES would be exactly the same, only the notional value, and you would need a larger account. The notional value would be bigger, but the strikes would be the same. Everything would be the same. So if you want me to run that through, you want to put on.
Yeah, let's run through. I can go to ES, so it'll be good for everybody to see it. You know, let's go to ES and let's do it again. So
Okay.
tell me where to go, and let's just set it up exactly like you would. Okay.
Okay.
Yeah,
So go down, please, to roughly go. Hold on. What do we have here? 73, 83. So it's unlikely that you'll have it in 73. So, but you can try. Just click on 73 and just go down to 9 delta and see what it pays. The highest paying one of the 9. So so let's go to 80 something. 86. There you go. And just go to highest paying 9 delta. There you go. So I would sell 2 of those.
Okay, so that's the 86 days. So where would we go for our
Just take a note that you pay that you're getting, let's say 2050. So the most you can pay for your what you should pay for your PDS, it would be 10.25 at the most, right? Half of this one, that give you 25%. This is just a shortcut, right? So now you can see, what do we have? 86, like between 59 and 86 is more than 21. So we wouldn't go there, right? So we would go to 73. So I generally go with what is the difference? So just no, wait there for a second, Bobby. I generally start with what is the difference between the two? It's 13 days roughly. So times 4, and then round it up. So it would be like 15 times 4, it's 60. So I would go with my long one, 60 points above the naked.
Okay, 60 points above the naked. So I forget what the
Roughly.
naked was. Where did our naked go?
You need somewhere to start, you know?
Yeah.
So you had it at, what was the naked one?
Why did it take my naked off that we had there? Oh, I know, because I did this. Hold on a second. Let me go back and get it and do this. Let me go back and grab it. So 86, go down to 9 delta. It was the 37.75.
Yeah.
Okay. All right. So let's do that.
No,
So-
these are just rough guides. So you would go somewhere to like 37.75 at 60 roughly. So that's 38, 50 roughly. Just put there. Okay, so put the long one. Okay, and then just go roughly down there. And I'm no longer limiting myself to 300. I will go longer if I can. I mean, wider if I can get it. So.
All right. And let me sell. We were going to do 2 of these.
Not one. Oh, 2 of these. No, I'm sorry.
Uh-oh. How do I choose that? Well, let me go back and find
And
it.
how wide was your put debit spread? I'm sorry, let me see.
300.
And how much did you pay for it?
That's the
Fine.
total trade there.
Right. No, so but you paid a little bit less. But okay. So that's fine. That's just about right. You got 40 and so 30. You should net 30. Yeah. So this can be the trade. You can move the short one of the put debit spread a little bit wider to get to
Mhm.
10.5, but you don't have to. Like, I mean, it's easy.
So move it 10 down.
No, you can or up 38.60, or you can just make it a little bit wider to get to your 10.25, because I think you paid 9.75, right? If I remember
Mhm.
seeing that. So what I'm saying is there is a little bit more room for you to, but okay, just leave it at that. You're fine. That's cool.
That's it. Yeah, that's good.
That's cool. Yeah. So now, if you go to curve and analysis, you will be
Mhm.
able. So let me tell you what I do when I analyze these. I would just take them, make it a little bit scroll up. So yeah, a little bit more, right? So now, if you open the side on the side here, let's say you go down. I would not analyze. I generally don't analyze for today, because I'm assuming nothing is going to happen today, but it might happen in a week or 2. So I would go out maybe 2 weeks to get a little bit more realistic picture.
Mhm.
And I would assume that in a market pullback of say 8%, the VIX will increase probably at least 15% from here. So I would just see where that gets me. If I get 15%, and then the market pullback, let me just figure out what that would be. 42.75. 15. So then I would analyze it at 36.50 roughly.
36.50.
Where am I?
Okay. There's 36.50.
Did I say that right? 8%. Let me see. 4.275 minus 7%. No, I'm sorry. 39.75. 7% down. I don't know what I was looking. Yeah, right.
Okay.
Okay. So if you compare that, the same metrics. So you're down 10,000 and change, right? On
Mhm.
30.75 with 15% down and 2 weeks out. So now, if you remember this structure, put it aside, and then if you want to compare this to your regular one that you would normally do, 50 wide and whatever you sell and something, and then just see where that would get you. Now it's 10,000. This is ES, obviously, so it would be around 1,000 on a MES.
Mhm.
And I'm thinking that roughly 1,000. If I had to take a loss of $1,000 on a trade on a huge pullback, when I'm thinking, that I might have to, it might get worse, right? So I want to get out, getting out $1,000 versus getting out at 1,600 or 1,700 that a 50 wide would give me. That's why I do these, yeah, to buy myself a little bit of time to amortize this blow down. But you can compare this exact thing against maybe the credit spread that James is doing, which is also great. It's just a different trade, but I find it that on a smaller pullback, like if it was a credit spread, and it would give me more protection going down further, obviously because it's limited, it's defined. But at 7 or 8%, I find that this one gives me a little bit more protection, and I don't intend to stay there and wait for the further, like for a 15% pullback or a 20 or something. So I'm optimizing, because you can't optimize for everything. You have to optimize for something, and I'm trying to optimize for a 7 to 10% pullback and a 15 to 20% increase in volatility. And in that case, I would try to get out. That won't work for everything, but it would be hard to optimize for for the crash and for the grind down at the same time, and something in the middle.
Okay, James has found the hand button. Yes, James.
I found the hand. It's Victor, if you go down where it says reactions on the bottom, on the bottom of your screen, click that, and then it gives you several options.
I got it.
Anyway, the question, before we move off of this screen, I was just curious of what this structure, what is the buying power reduction for what we just put on? I can't see that here.
Let's see, it was 7,000, 7,100.
7,100, yeah.
Okay, all right. No, I'm kind of intrigued by what I'm seeing there.
Right, if you just put the 50 wide, you will see that the buying power will go up. I'm not sure how much would go exactly, but
If it's 50 wide, yes, 8,800, but we would be moving up this way, right? So 40, 60, 40, 10. I don't know where exactly we'd be, but that's more like our traditional.
so it's $1,500 difference in buying power. It's around 20% of the 7,000. So it's something, it's not huge, but it's an added bonus, I'd say. And I think that buying power would, the buying power savings would increase in the market pullback, because that structure would be coming closer to the money, although the naked puts would obviously increase in requirement, but that's besides the point.
Well, and the other thing, you're not holding either one of these to maturity. You're
correct
out in, I guess your rule of thumb is half-life or out in 30 days.
No, my rule of thumb is because everything is structured to get 50%, and I like to be able to plan for other reasons. For example, I put some call spread credit spreads on the call side, but I want to know how much I can risk and still not go down, not go negative. Actually, still make money even if the market goes through my credit spreads. So to be able to do that, I want to know how much I'm making per, and also for other planning, right? So I want to net 50% minimum, unless there is something unusual happening. 50% minimum of what I collected on naked puts after commissions. So to do that, if I do this, if I pay 25% for the put debit spread and close it at 80, I will get 50%, because you figure you have 25% and then 5% in closing costs, so that's 30%. 30 plus 50 is 80, and then I close it down. So let's say the market pulls a little bit, and I'm not getting to my 80%. But if I can take a look at how much the put debit spread is worth, and if it's enough to compensate for the 20%, I can close the whole structure and get out. I just want 50%. So if I can, I'll get out from the whole thing.
Yes, sir. So profit target of 50%, that makes sense. So what's your average days in trade to achieve that?
So it's been around 40 days. because I had some trades that starts at 80, some at 65, 70, anything in between. So it's kind of converging around 40 days, but they can be, I mean, it's work in progress, but it's around 40 days roughly.
Thank you.
Great. Any other questions? Okay. If not, I will see y'all tomorrow. Thanks, Victor, for sharing with us. We appreciate that.
Pleasure.
See everybody tomorrow.